The New Orleans Conference, the world's greatest investment event.
First up from the real estate guys is Robert Helms.
Sir. Thanks, Gary. Gary Alexander, ladies and gentlemen. That's a tough job emceeing, so I hear. How's everyone doing? How many of you wish that you owned more real estate than you do? Who would like to own more real estate in the future than they do now? Here's the great thing about the next 20 years. It's going to be here 20 years from now, whether you do anything about it or not. So we're going to share some ideas about how you keep it real, understanding that we're at a resource conference. We believe that real estate is maybe the ultimate resource. I mean, where does oil and gas and gold come from? The ground, right? And before we're done today, you're going to hear from not only Robert Kiyosaki, but Tom Wheelwright, who is Robert's CPA, who is really got a lot to say about how keeping it real also lets you save more money if you understand taxes. So we have a lot to talk about. Our show is heard in lots of different places. More than 190 countries. You can find us on iTunes and Stitcher and all your favorite podcast places. The podcast is free, and we'd love to have you listen to it. That's enough about us. We're easy to find, and we keep showing up. So let's talk about living in an unreal world. Who remembers Bizarro World from Superman? Who's old enough to remember that, right? Everything's opposite, everything's different, everything's not real. Growing up, learning about economics, it seemed like it was all based on sound footing, but in the last couple of days, we've learned that all is not appears. Apparently right now, unproductive debt doesn't seem to matter. And people borrow and consume in order to prosper. I guess all you have to do is rack up your credit card and you have a good high level of living. Consumption is production, they say today, or at least the Keynesians believe. And profits are wealth, no matter how you got them. And I'm not sure that's true. We're going to share with you some ideas that maybe will have you think a little different and change your paradigm, because paper investment and paper returns aren't the same as real money. But in this house, you probably already understand that. We aren't political in any way. We are just guys that look at how things that happen in the business world affect our lives from an economic viewpoint and even a bigger picture than that. And so here's a chart you've probably already seen. But here's the context of this. Those things that we just talked about, the unreal nature of what's happened in the markets and what's happened in our world, in our financial system, in the Federal Reserve and all of that, leads to people's beliefs. And the way you believe affects your actions, and the actions you take affect your results. That's true for all of your life. If you believe something and you take certain actions and you get results, if you don't like the results, you got to go back and change the beliefs. Well, the way that's manifested is in an unbelievable amount of debt. Right? All the charts seem to go the same way. There's some clues in there. And here's the challenges all investors face, not just real estate investors. We're not going to show you the chart because lots of people have, and we showed it to you the other day, but the dollar has trended in one direction since it began. And was that direction up or down? Duh, right? I mean, it's pretty clear. It's not like a little bit down. It's always down, and that's a problem. At the same time, interest rates are headed which way? Up after a long time of being down. That's a problem. We have a good economy, perhaps, but it's sitting on a very fragile economic foundation. Our system is a challenge, and that creates unnecessary, skepticism, I guess, from investors. And then you've got all the stories of the pension funds that are underfunded and how people that are no longer productive or, not getting the money they were promised and those kinds of things, which are scary time to be an investor. We've got more and more debt just to cover the interest on the debt. It's crazy. We talk a lot about counterparty risk in real estate because there's always somebody on the other side of a transaction. Not in every type of asset class, not a lot of counterparty risk in oil in silver or gold, and not much in real estate. Then, of course, privacy. Today, we give up privacy for convenience, and yet our privacy is eroding. So a lot of challenges faced as investors. We're not here to say real estate can handle all the challenges, but there's some ways it can certainly help. So we have to understand our paradigm. We think and behave a certain way based on what we've been taught. And one of my favorite things about one of our speakers coming up later today, Mr. Robert Kiyosaki, is he challenges us to think differently. He says the rich don't work for money. He says your house is not an asset, it's a liability because it takes money out of your pocket every month instead of putting money into your pocket. And that challenges a long-held belief that, no, my house is my biggest asset. No, it's not. So we have to take the red pill and see how things really are. And so a big question is, what is wealth? Is wealth what your balance sheet says? Is it your net worth? Or is wealth your cash flow statement? Is your income that's coming in? And there's two sides of a coin there, right? There's certainly we want our net worth to increase, but there's income. And so we're going to challenge and paradigm that a little bit this afternoon on that. And then here's the other thing. When we talk about value investing, this concept of income versus comparative sampling. Now, what do I mean by that? Well, I'll show you in a second. How did Apple do last couple of days? Apple stock, where's Apple stock? Up or down? Like down a lot, right? So, follow me on this. A share of Apple stock is worth whatever the market says. Today, it's essentially a perfect market. I can't go find a guy that wants to unload and buy Apple stock at a bargain, right? It's going to be, the price is going to be what the price is based on what the most recent shares have sold for, the comparative sampling. In real estate, it's really interesting. We have what we would consider value in our home. But do we really? We would submit to you that's perhaps a fake valuation. How can Netflix and Tesla be worth so much money when they don't make any money and may never make any money? This can mess with your brain. So let's talk about how that manifests in real estate. Imagine there's $1 million economy made up of 10 houses and each one's $100,000. That's our entire economy. That's your little cul-de-sac you live on. And then because the economy's good and stock prices are rising and so forth, now one of the folks on your street decides to put their home up for sale, and you know what? It sells, and it sells for $200,000. Well, the way that comparative sampling works in real estate, it tells me that all of a sudden every house on that street is now worth $200,000 if they're all the same size and utility and so forth. So all of a sudden the entire economy has grown by $1 million. It's doubled. But that's just not true, and here's why. If every other of the 9 houses were to go on the market, would they all sell at $200,000? No, as soon as all the houses go on the market, the price goes down. So the comparative sample method says that, well, my stock holdings are worth this today, or an ounce of silver is worth this today, but that's going to change tomorrow. And if everybody sells, then the price can't hold. Now, there's a part of real estate that's not true for, and that's the monthly income, the rental income. It's not a comparative sample that affects if everybody moves in or out, because those transactions settle every single month. My tenant pays me every single month, every single month, every single month, and so do all the tenants. So that is a comparative sampling that is a true indication of the value. I know it takes a lot to get your mind around that, but here is the premise that unrealized gains aren't really real. Unrealized gains are not really real. Really, they're not. You might stack up a bunch of gold coins, but right, if you're trying to convert those to dollars, which is the wrong way to think about gold in my opinion, then, you know, as soon as everybody goes to sell, well, you know what we're saying. All right, so Apple stock suffers worst day in more than 4 years. That was yesterday. I couldn't find any more current news than that. And people all of a sudden hit the sell button, and that makes it worse. Prices go down worse. America lost trillions. Now, this is a chart from a little while back when the housing bubble went through, and oh my gosh, look at all the money we lost. The bubble, the air came out of the bubble. But it's interesting because was that money ever really there? If everyone had tried to sell all their houses at those inflated prices, it wasn't going to happen anyway. And then it goes the other way. Household net worth climbed by $2.3 trillion in the first quarter of 2017. But did it really? What if everyone went to sell those properties? It's not going to hold. So income is real. When you have income from rental property that comes in every month and they're paying the rent and they're going to work every day for somebody else and you're not managing them, but they pay you a big chunk, 30, 40% of their income goes to you as the landlord, that's real because it settles every month. But the price of the asset, that's fake. That's only today in the bubble. And if on your street you're the only house that sells and there's good demand this month for houses, you'll do fine. But you can't assume that just because it's on your balance sheet, it really is an asset that's real. So real estate equity has gone up and gone up and gone up, and our book Equity Happens, we cited that for 40 years in a row, the median price had never gone down in real estate until it did. And look what happened at the real estate bubble. Oh my gosh, that was pretty ugly. And then it's bounced back. Oh my gosh, who lives in a housing market where the prices have bounced back? Yeah, and some of them have bounced back a lot. Now, I'm no expert at this stuff, but it looks to me like there could be another bubble forming. I don't know, it could be. Now people saw this chart, right? Here's the chart you may not have seen. Why the asset price changed drastically. The income did not. These are rents. Even though the housing prices came down, the rent came down a little, but not a lot, because those transactions settle across millions of properties every single month. Now, here's what a lot of people like to do when they invest. They take cash, they invest in something like a house or Bitcoin or gold, you could call that an investment, so they can sell it again later for more dollars. Cash to asset to cash. Now, we're not sure that's a good way to go, because I think owning assets is much better than owning cash. As Robert Kiyosaki will tell you, cash is trash. So what we like to do is go cash to asset to cash flow. An investment that pays us every month or every quarter or every year. It's not just, residential real estate. There's all kinds of ways. Agricultural crops might pay once a year. Oil and gas pays when it does, right? So different ways to go from cash to asset to cash, where the game is to accumulate the efforts of others through cash flow, not to accumulate a big pile of dollars. What are you going to do with that? So when you manage debt, equity, and cash flow strategically, then you can use real estate to grow and preserve wealth, produce tax-free income, truly tax-free. You're going to hear about that from our good friend Tom Wheelwright in a few minutes. And what we call infinite returns. Infinite returns means you're on the house's money. And before we're done today, you're going to hear about infinite returns. We talked about it in our breakout session last night. And thanks to everybody who came. That was the fullest breakout session at 8 o'clock I've ever seen at this conference. Crazy good. So thanks for coming out for that. And that will hedge against inflation, deflation, and recession. If you didn't see our presentation the other day, real estate can actually hedge against both inflation and deflation and recession in case we get one of those. So how do you put the pieces of all that puzzle together? Well, it takes a bigger brain than I have. Please welcome the co-host of the Real Estate Guys radio program, Mr. Russell Gray.
Thank you, sir. Right on time. That's awesome. So thank you so much for coming out. It's been a great conference. Here we are, I don't know, third day in, second day in, something like that. We got one more day left, right? Tomorrow we get to hear from Peter Schiff. So Peter Schiff's a big part of the reason why we're here, because in 2005, 2006, equity was happening and just up, and people were sounding the warning bells. Two guys, Robert Kiyosaki and Peter Schiff, were telling the world that the real estate market was in trouble. And a lot of us, including myself, didn't listen. And so now I pay very close attention, and I pay close attention to those guys. And it's tough because you got to be brave. Those guys are very brave. They will stand there all by themselves, and they will say what they think, and they will back up what they think. And everybody stands against them. They laugh at them. We've got some videos on our website of those two guys just getting heckled over trying to warn people what was coming. And sure enough, they turned out to be right. And so, nobody wants to hear the Jeremiah prophet, Nobody wants to hear that the end is coming when it's all fun and games. But you can clearly see when you take a look at what's going on in the financial system, there's some things to be concerned about. Now, that doesn't mean that you lose money. It just means you need to position yourself differently so that you can make money. After the 2008 crash happened, I was in the mortgage business, lost a lot of money in the mortgage business. I had a lot of highly leveraged real estate that was negative cash flow. And I was using the income from the mortgage business to be able to feed the real estate. It all looked good on paper, but it was all dependent upon healthy credit markets. And I didn't understand credit markets, so I couldn't see the risk to the credit markets. Today I see interest rates rising. I understand the credit markets and the bond market a lot better. And I see a lot of instability. And so I'm positioned very, very differently. I'm actually looking forward to the next bubble bursting, because it's a shopping spree if you're in the right position. So we're here to help you understand some of those concepts from a real estate perspective. And so, Robert kind of has done a great job there setting the table, helping you understand a little bit about, the way we look at real estate and the major paradigm shift from going from cash to asset to cash and trying to generate dollars to wanting to accumulate assets that put cash flow into your pocket. It's a premise that Robert Kiyosaki teaches in Rich Dad, Poor Dad. And, I mean, many of you have come up to him since he's been here and just thanked him for how he's changed your life. And for those of you that haven't had a chance to hear him speak before, or hear his concepts, you're in for a treat in just a few minutes. So solving this puzzle it kind of looks like this. If you're looking at the marketplace and you see a bunch of equity sitting there in real estate, and you realize, that equity can't be there forever. If the credit market sees up, if for whatever reason we have a recession and wages don't keep going up but they go down, if interest rates rise and people can't lever their income into bigger mortgages, if any one of a number of things happen, you could see the market take that equity away. And a lot of people are thinking, oh, I got to pay down my loan in order to be safe. But that's crazy. There was a lot of people that were paying their loans down going into the crisis in 2008, and then the market just took the money away anyway. And so that's not the way to do it. Some people got out of the real estate market and tried to come back in, but it's very expensive to move in and out of real estate, and it's very, very hard to time the market. So the whole concept of what I'm about to show you is a way just to rearrange things so it doesn't really matter what happens. Interest rates can go up, interest rates can go down. We can have a recession, we can have a booming economy. Credit markets can seize up, it really doesn't matter. And so that's the point that we want to make here. So let's just start with this idea that you've got some equity in some real estate somewhere. If you don't, then imagine you have some other asset you could borrow against. I just always use real estate. It's my mortgage background. It's my favorite thing to leverage because you can take the money at very inexpensive rates, lock it in for a long, long time, and then put it to work doing other things. And so if we pull $200,000 out at 4.5%, we're going to have $9,000 of interest a year. That's our cost of that debt. And of course, that's tax deductible if you're going to be using it for investment purposes. But I'm not a CPA. Check with your tax advisor or talk to Tom Wheelwright, who will be up here shortly. But now you've converted your equity to cash. So in exchange for a $9,000 a year payment, you put $200,000 of cash out of your property that you can put to work. So you get to keep the property. So if the property has upside, you get to keep it. If you enjoy using the property for whatever purpose, you can keep that. If it's producing income because you're renting it out, you can keep that. And you have no counterparty. In fact, you are the counterparty. And so you're in a situation where you're more liquid going into a time when liquidity is not to be found in the marketplace. It's always good to be liquid. So now you decide, well, what I want to do is I can't just sit there and pay $9,000. I got to handle that payment. And so you use private lending. Now, if you're not familiar with real estate, the equivalent to bonds in real estate are mortgages. And you can make private mortgages. So you can go out and you can loan somebody who maybe doesn't have a fit-in-the-box credit score or financial documentation. Maybe they're a foreign national, but they'd like to buy real estate. They'd like to buy a home. They'll put 30 or 40% down and pay you considerably more than the going rate. So, in fact, we got a guy right here that does private lending from Nashville, Tennessee. So you take $100,000, you take half of the cash that you had, and you invest it out at 9% in two $50,000 mortgages on these little $60,000, $70,000 houses in what they call flyover America, right? And you got 30 to 40% protective equity, which means if the person stops paying, you would happily take it at a 30 to 40% discount. Even if we had some deflation, you've got quite a bit of cushion there. And if it was underwritten properly, then there should be enough income on the property that if the person who was in it fails to pay, you evict them and put somebody in who will. You can't evict a bond issuer. Somebody gives you a bond and defaults on the bond, you can't kick them out and put somebody else in their place. But with real estate, you can, whether it's a tenant or a borrower. And it's one of the great things about real estate. Anyway, by doing the math, you see that we got $9,000 of interest going out, you got $9,000 of interest coming in, but we only had to deploy half our capital to do it, so we've got $100,000 of cash now that's free to do something else with. So let's see what else we could do with it. Let's say that we wanted to hedge against long-term inflation. So let's take half of that $50,000 and just go buy some precious metals. Let's put them in a safe somewhere outside the banking system. Now I've mitigated the banking system. I've mitigated the falling dollar. No counterparty risk. I have great liquidity. I can pivot into any currency I want because there is almost always a bid in any currency for gold. Does that make sense? Okay, so now I still got $50,000 left over. So now I'm going to take my $50,000, of which I have no payment attached, and I might say, hey, you know what I'm going to do is I'm going to do what Jim Rickards says in Currency Wars. I'm just going to go park that wealth somewhere in developable land and just wait until everything falls apart, and then I will be able to get cheap labor and cheap supplies and develop that property and make a profit. So if you've read Currency Wars, Death of Money, That's an idea that Jim Rickards put out. You may decide, you know what, I don't want to do that. I'd rather have some form of income, but I want to get something that's real and substantial, necessary. I don't want to speculate on tech or something that, discretionary spending. I mean, there's not too many things that are more essential in life than having a roof over your head and having food on your table. And the great news about farmland is you don't have to get the local economy right, because the crops grow where they grow best, and then people eat them where they live, and you just ship them to get there. So when you buy a rental property, you've got to get the local economy right. You've got to get the local jobs market right. You've got to understand the supply and demand dynamics. A little bit different when you buy productive farmland. And we got a couple of people out here in the exhibit hall that actually will let you get into deals where $50,000 and you can buy a chunk of productive farmland. So if you haven't talked to them, make sure you go out there and do that. Last night at our breakout session, we showed you how to do it with resort property. You can buy a resort property or a piece of a resort property, and you can have some personal use. You can have tax-deductible travel to visit your investment property. You can have some income coming in. You have a professionally managed quality asset. Because it's one thing when you go make these, you have a tenant in a C-class property and they don't pay, they trash the place, and you've got all kinds of capital expenditure to turn the property. But resort property is a little bit different because the manager's in control of the property. And so you don't have that kind of damage to the property that you do in a low-end investment property, a low-end rental property. You can do it domestically, or you could go offshore. We talked in our pre-conference workshop about the advantages of going offshore. Puts you in a different jurisdiction. It makes it very hard to find those assets from just a routine asset search. If you got a frivolous lawsuit attorney chasing you around and trying to just find something to pin on you, they're not going to find those assets. If you structure yourself properly, you can hide many of your assets. You're not hiding them from the IRS necessarily. You're not trying to evade any responsibilities you have. You're just taking the target off your back. If you've done well and you've accumulated some wealth, and all of a sudden you just got that thing hanging out there in the wind, every account in your Social Security number, every single piece of property you own in databases in the United States with your name attached to it, very easy to find everything you own. These types of structures, you can camouflage all of that and take advantage of privacy. And you may decide, hey, I don't want to own the land directly. What I'm going to do is I'm going to invest in a private placement. Our pre-conference workshop was about private placements. We've got the Real Estate Fund Alliance out there, which is an alliance of individual fund managers, syndicators, that are raising money from investors that want to be hands-off. They want to be in real estate. They want to take advantage of real estate. They just don't want to get their hands dirty. So just like a mutual fund, you turn it over to a syndicator, and then they run the project for you. The only difference is it's very, very flat. When you deal with a syndicator or someone like that, you're dealing pretty much directly with the principal, or maybe somebody who works directly with the principal. If you think about what happens when you go do business with Wall Street and fund managers, you're dealing with people that are, there's layers and layers and layers between the asset and the income and the profit on the asset and you. Those big buildings and those fancy commercials and those jets and all the things that you see that are part of that industry, that money comes from someplace, and I'm pretty sure it's you. So just be aware of that. And then, of course, private placements give you the ability to keep your affairs more private. So there's a lot of things that you can do. So just in closing here, and I can't believe it, we're actually going to finish ahead of schedule, which is great. We just want to cover this real quick. So I've probably shown this thing the last 2 or 3 years that I've come here to the New Orleans Investment Conference. And we talked earlier about the importance of kind of shifting a paradigm. One of the important paradigm shifts here that Robert shared with you is that asset values and net worth are very volatile, very fake. Income is very real and much more stable. We can show that. We showed the charts. We can show you that. That's one paradigm. The second paradigm is that when you invest, that you have to the buy low, sell high, and the idea that going from cash to asset to cash. This is the thing. Brian London and I joke about this all the time because we talk about gold. I look at gold very differently because I'm not a gold guy. I look at gold as a store of a unit of value, and I want to have more units of real value. So when it goes on sale, meaning the price drops and the dollar's strong, I get excited and go get more. So I'm the opposite. I'm not looking to sell it. If I need liquidity, I probably would borrow against it, just like I would borrow against real estate, and then just arbitrage whatever the cost. If I borrowed at 5, I would invest at 5+, and it makes it worth the round trip. But the other thing here is just understanding that you can take control of your financials and begin to structure yourself in such a way that you aren't a target, that you can have privacy in your affairs, that you can have more direct control over the people you work with and the assets that you have and direction about what's going on. So at the low-hanging fruit, where most people in America are, they own paper assets, stocks, bonds, mutual funds, 401ks. Insurance contracts. They own bank accounts with their social security numbers all over them, you know, and I joked about that. You put your money in a bank and over $250,000, you're not insured. Below $250,000, you have insurance from the FDIC, so an insolvent institution has insurance from an insolvent institution that is backed up by the printing press of the United States, which is an insolvent institution, right? So you got to think about that. You know, it's all good if the printing press works, and one of the things we spend a lot of time talking about and paying attention to is the dollar status as reserve currency. That's under attack right now. Now, it's not going to fall apart tomorrow. It might take years, but we don't know. But Russia and China and many other countries are looking for all kinds of different ways to circumvent the dollar. If the United States loses their credit line, which is the reserve currency status, and Jim Rickards calls that an ICE 9 lockdown, the system freezes until there's a reset. If you have everything in that system when it freezes, then you're like the people in Cyprus and Greece were when they're standing at the ATM trying to get a few bucks to buy food and gas. So that's low-hanging fruit. The lawyers can find you, the creditors and predators can find you, and everything is locked down if something happens. But if you climb up the tree a little bit, then you can use domestic real assets, gold outside the system, private placements, direct ownership of real estate and other things like that. You can use private entity structures and private banking concept. Go a little bit higher and you go international. When you go international, you are very, very difficult to go after. It could cost a plaintiff's attorney hundreds of thousands of dollars to litigate, to chase your assets if you've got them spread out in multiple jurisdictions, if they can even find them. Now, they may decide to get a judgment against you, and then you got to go in and tell everybody where stuff is, but I'll be honest with you, I've gone through that because I signed some personal guarantees on some construction loans pre-crash. And when those went bad, the projects failed, I owed the money, and I legit owned the money. I didn't fight it. They got a default judgment. They called me in. I had to do the order of examination. I had to tell them where the stuff was. And fortunately, everything I had was offshore. And they looked at it, and they went, all right. Then they walked. That was it. So I've become a big believer in international structure. So if you're not there yet, just like take the red pill and open up your mind a little bit and consider the possibilities, because you're more of a target probably than you realize. And in desperate times, governments and people do desperate things and go after people with money. So international real estate assets, international private placements, private entity structures, private banking. So with that, I will thank you very much. Oh, no, I got a couple more things I got to tell you. So getting there from here, all right? If you're sitting here like, okay, that's interesting. These guys just force-fed me like drinking from a fire hose for 28 minutes, and I'm interested, but man, you know, so we call it the law of diminishing intent. You hear like, oh, that's intriguing. I want to follow up on that. And we know what's going to happen. You're going to walk out the door. Your head is exploding because you've had all these brilliant speakers filling your mind up with all this stuff, and then you're going to go back home this week, and your schedule is going to eat you up. Right? Is that what happens? It's exactly what happens. And so knowledge is only good if you act upon it. So our motto at the Real Estate Guys for years and years has been education for effective action. And so the way that works out is you got to have the knowledge. You're at the beginning of this knowledge, some of you. Now, some of you that are listeners have been following us for a while. Maybe this is old school. But if you're for the very first time, like, wow, I never thought of it that way. That's pretty interesting. So we have podcasts. We do educational courses. We do live events. We put on conferences. We speak in different places. Lots and lots of education. We understand it takes some education. For you to change your investment results, you have to change yourself as an investor. It starts in the way you think and what you believe, and that will affect the decisions you make, which will affect the results you produce. So it starts with knowledge. The other key part is a network. Real estate, you can't sit in your diaper in your crib with your trading app and dial up these kind of deals. It doesn't work that way. Our business is a relationship business. And so getting plugged into a network of people that are doing these kind of deals, that are in the deal flow, that are raising capital, that are able to either share ideas with you or actually partner with you on deals, however you choose to do it. And again, you can be hands-off. You don't have to be dealing with tenants and toilets, but you do want to make sure that you understand how to evaluate what you're looking at and who you're doing business with, and then you turn the money. It's probably a lot more due diligence than a lot of folks do on the paper assets they buy every day. They just see them advertised, somebody gives a ticker symbol, they write it down, they go buy it, and they really don't do the homework. So having a great network and a great team of advisors, great CPAs, great mortgage people, tax advisors, people that can help you, that's really important. So those are kind of 3 things you go to work on right away. To help you do that, we put on some events where you get to meet some people. So one of the things we're doing is, how many of you guys know Peter Schiff? Peter Schiff. Peter Schiff's a pretty famous guy, pretty smart guy. We're throwing a birthday party for Peter aboard our 17th Annual Investor Summit at Sea. So Peter has been great attending this event and teaching. It's probably his 6th or 7th year with us. Robert Kiyosaki's coming back. Just told us last week he's committed to coming back, I think, for his 5th or 6th time. G. Edward Griffin wrote the book Creature from Jekyll Island. If you want to really get your mind bent about the roots of the Federal Reserve System and this entire monetary system that we work in, have a dinner conversation with Ed Griffin. He'll really blow your mind. Chris Martinson, who I believe spoke this morning, he'll be with us. Tom Wheelwright is just on the day. He's a CPA and he can't make it for the whole trip because it's tax season. There's a lot going on, but he's going to come share a concept called infinite returns. I'm sure you're going to get a preview of that. Brian London will be with us, and many. Gene Garino, who you heard earlier, many people. You will get more done in terms of your financial education in this space, in the real asset investing space with real estate at the hub, and building relationships both with fellow investors and key people, advisors and providers. You'll get more done in a week, and nothing is for sale. It's all education and networking, and it's a blast. I hope you decide to join us. Thank you very much. If you want more information from us, just send an email to NOIC18@realestateguysradio.com. We got 2 free reports for you, Real Asset Investing and New Law Breaks Wall Street Monopoly. We'll tell you about our investor registry where you can get into the deal flow, tell you about the summit, and tell you how you can get a hold of our free podcast and free newsletter. Thank you very much.